Physical Gold Fund presents the Gold Chronicles with Jim Rickards and Alex Stanczyk. Insights and analysis about economics, geopolitics, global finance, and gold.
Hello, this is Alex Stanczyk, and I have with me Mr. Jim Rickards today. Welcome, Jim, back to the podcast.
Thanks, Alex. Great to be with you.
We have a number of different subjects today that include cryptocurrency. We're going to talk a little bit about the G20, Syria. We're going to talk about North Korea. Let's start with cryptocurrencies. We have listeners who are interested in crypto but are not really seasoned, what I would consider crypto enthusiasts. And for the portion of the audience who are not really highly technical, there's a desire to know more about crypto in terms they can understand. So we're going to discuss that a bit today. But I would like to lay down a few thoughts to sort of set a foundation for the topic. First of all, this is not about cryptocurrency bashing. Personally, I like the idea of a distributed ledger. I think it's fascinating technology, and the potential for the blockchain technology is really interesting. This also isn't about whether gold is better than cryptocurrency or vice versa. The truth is, crypto is still in its infancy, and it does not really even come close to gold in terms of practical application yet. Gold's market cap is in the neighborhood of 7.4 trillion as of the last estimates we've got from our sources. Global Forex, other currencies, for example, are multiple times this in size, and all crypto combined is sitting at a market cap of about 112 billion. So while the technology has great potential, cryptocurrencies themselves have a long way to go before global markets take them seriously as a money alternative of any depth and liquidity. There's been a lot of buzz surrounding crypto that, from my observation, does not take into account the reality of the global regulatory landscape we live in today. For example, because it's crypto or because it's an ICO, which is an acronym for an initial coin offering, if this ICO is in a country outside the U.S., there seems to be this belief that somehow it's protected from regulatory reach. And one of the things I wanted to talk about today, Jim, is that this is either a lack of understanding of how regulatory enforcement actually works on a global level, or possibly it's just maybe a little bit of confirmation bias going on there that's blinding people to how things are really working. Now, I want the listeners to keep in mind that I'm not pretending to be any kind of technical expert on cryptocurrency. What I'm addressing is what appears to me to be gigantic gaping holes in the attention given to regulatory compliance and this idea that crypto is somehow beyond the reach of government. Jim, I'm going to be asking you for your input on this in a moment, but for now, let me just add a little bit more foundation. Right now, ICOs are popping up like crazy. It's kind of like the Wild West. And again, an ICO is an initial coin offering. It's like a brand new cryptocurrency that people are pouring money into. My observation is that the majority of these ICOs may not understand the legal implications of what they're doing. In the area of what regulators could view as either issuance of securities, but also a lot of them are in non-compliance with international AML KYC frameworks such as FATCA, CRS, and IGA. So FATCA stands for the Foreign Accounting Tax Compliance Act, and this is an intergovernmental treaty framework that the U.S. has pushed. CRS is an OECD framework, and IGA is put forward by the UK. These things all need to be taken seriously, and there's a host of regulatory bodies from a number of countries that are monitoring what's happening in crypto. Even if they're not aggressively pursuing enforcement actions, they're well aware of activity in the space. So from the US in particular, the regulators who have potential oversight here are the SEC, the CFTC, and I'd like to point out particularly FinCEN. Now, FinCEN stands for the Financial Enforcement Crimes Enforcement. Wait a minute.
Financial Crimes Enforcement Network.
That's what it is. Thanks, Jim. All it would take would be for crypto to be classified as a primary tool for terrorist financing, and then all kinds of risks start to open up. I want to be clear here. I'm not suggesting crypto is a primary channel for these kind of activities. What I'm saying is that if a regulator such as FinCEN claims that it is, that's all it's going to take for this to have serious potential repercussions. So at this point, some people who are familiar with crypto might make the argument that just like gold, if it's used in total isolation, it works, which I grant is true, but not for any serious liquidity. So for example, what I mean by that is you can bury gold in the backyard, but in serious quantity, who are you going to sell it to later and expect it to remain secret or safe during such a transaction? With crypto, you can avoid digital exchanges. You can go point to point directly. You could try to avoid interfacing with anything that touches USD transactions. But in doing so, your world of potential transactions and importantly options for liquidity and size diminishes substantially if an actor tries to take this isolation route. So Jim, considering that regulators could take the view that ICOs are acting as non-compliant financial services entities, what are your thoughts in this area in terms of the tools that regulators have to bring to bear on US dollar transactions in cryptocurrency or other risks you see here?
Well, thanks, Alex. That was a great introduction. I think the first thing I would say is that this is a huge topic. When we say cryptocurrencies, blockchain technology, initial coin offerings, what are called safe contracts or smart contracts, and the various uses, the legal regulatory regimes. I'll talk a little bit more about all that. But these are each topic I just mentioned is a big topic in itself, and they all sort of get swept under the banner of crypto. So for those not familiar, I mean, this all originates with a certain kind of technology, a certain protocol called the blockchain. And what it basically is it's just a record keeping. It's a ledger, So, right now, certainly for hundreds of years, but it's still true today, if you bought a property from somebody, some real estate, you'd show up at the closing, or your lawyer would show up at the closing, and the seller would have a deed, and they would sign it over to you, and you would take that deed. And again, it could be you, or more likely your lawyer or clerk or somebody would go down to the town hall and hand that to the town clerk, and the town clerk would literally write it down. Maybe they type it in a ledger, a land record, and put a stamp on it and give it back to you, and they would mail it back to you, and you'd put it in your safe deposit box, etc. But anyway, that deed would be your legal document representing your title to that land. Now, think about all the steps I just described. The fact that there's paper involved, the fact that it's got to go through many hands, lawyer, clerk, the town clerk, back to you, buyer, seller, etc. It's legally binding. It's recognized by the courts. It's the way things are still done today. And you can go down to the town hall on your own. These are public records, and pick out a lot number and a block number. That's usually how they're categorized. And, block 22, lot 15, and look it up and find out who owns it today and who they bought it from, all the way back to however, maybe the Revolutionary War for that matter. So that's an example of a ledger and a record-keeping method to establish title. Now, what the blockchain does, it does a couple things. First of all, it's completely digital, so forget the paper side of it. Secondly, it's heavily encrypted with what's called military-grade encryption, which is, at least as far as I know, unbreakable. If there's any way to break it, I promise you it is the most closely held secret of any government in the world. And certainly people are working on it all the time. But it's for all practical purposes, and again, as far as I know, it's unbreakable. Unless you give away your key, you have a certain alphanumeric code that is your key. And as long as you keep that private and don't give it away, then you're the only one who can unlock the encryption. So it's heavily encrypted. It's digital, so it's virtually free to move it around. But most importantly, it's distributed. What distributed means is that this ledger resides on, I could say thousands, but really millions or potentially tens of millions of computers and servers all over the world. That's a big deal, because if you go if I burn down a town hall, not a very pleasant thought, but I guess, if there were a fire in the town hall and all those paper records I just described were destroyed, you'd have a heck of a time recreating all that. But if you literally blew up a computer that had this ledger on it, it wouldn't matter because the same ledger exists on all these other computers. And it's the community as a whole that verifies it. And if one party says, I own this certain asset, it could be a Bitcoin or it could be any other asset. We'll talk about that in a minute. And the whole community says, no, you don't. We all have the same ledger. And we see that, this went to a certain party. Again, this is all encrypted, but it went from A to B. Ms. B is the owner. That's that. So you have the benefit of digitization, encryption, and distribution. Those are three very powerful tools. So that's the blockchain technology. Now, what can you do with the blockchain technology? Well, one thing you can do, and this has been done, is create a cryptocurrency. And Bitcoin's the most famous or most best known, but there are many of them out there. I was involved with one working group, and we had identified 90, but that was a while ago, and I'm sure there are many more than that. And some of them have larger amounts of circulation, larger followings, if you will, greater liquidity is the way I think about it from an economic perspective than others. But they're all out there. How do you get some of this currency? How do you get a Bitcoin? Well, you can sell something and accept Bitcoin payments. So I have a store on my website, the James Rickards Project, and we have a store and we accept Bitcoin. So you could pay me a Bitcoin for one of our goods, et cetera. So you can sell things for Bitcoins. You can go buy a Bitcoin. You can take dollars or euros for that matter and go to one of these Bitcoin exchanges, and there are exchanges popping up all over, and buy a Bitcoin, or you can mine them. Now, again, the word mining obviously is a reference to, or at least an analog of gold mining. Of course, there's nothing at all like gold mining. I've been in gold mines. I've visited gold mining sites. It's one of the grittiest, most physical businesses you can imagine. You got to drill cores and walk around in remote areas that are either freezing or equatorial swamps or deserts. It's a nasty business. You got all kinds of machines and backhoes and all that stuff. So gold mining is a very hands-on, gritty business. But mining Bitcoins is or any cryptocurrency is quite the opposite. What it does take is massive computing power. And the Bitcoin protocol is basically just to simplify, you solve these really difficult math problems, these problems that take a lot of number crunching, a lot of computing power, a lot of energy. By the way, one of the criticisms of Bitcoin is that the amount of energy that's being sucked up to create these Bitcoins, to these minings, is itself a waste. We're burning a lot of coal somewhere in the atmosphere, or nuclear power, some other things that people don't like to generate electricity, so Bitcoin miners can go about the work. So that's one. I'll just leave that as an aside. Some of the big Bitcoin mines, and again, this is a metaphor, but the mine is actually at this point a very large warehouse-sized facility with lots of servers and processing power going on, are being put in Iceland because, first of all, it's pretty cool in Iceland. You generate a lot of heat with that much computing power, but also because the energy is relatively inexpensive there because they have geothermal and a couple other things. So that's the kind of Bitcoin mining. And by the way, these math problems that I described, they get harder. So every time somebody mines a Bitcoin, the next problem gets a little bit harder. And so it kind of grows exponentially to the point where the last few Bitcoins that ever get mined are going to be the amount of processing power that goes into it is going to be just enormous. So, but as a miner, if you solve the problem, you get a Bitcoin. That becomes your reward, or however many you get. So I understand that I haven't verified this myself, but I heard from third parties that today it costs about $1,000 to mine a Bitcoin. Bear in mind, we're pretty far down the road with these things. Originally, it would have been far less than that, but the Bitcoin are selling for on exchanges for between $2,000 and $3,000. It's volatile, so I guess it's like gold mining. You know, if I can mine the gold for $800 an ounce and sell it for $1,200 an ounce, I can make some money. And if I can mine a Bitcoin for $1,000 and sell it for $2,000 or $3,000, obviously you can make money doing that. So that's the currency part of it. Now let's talk a little bit about Ethereum and ICO's initial coin offerings. So I said there are many cryptocurrencies other than Bitcoins, but these initial coin offerings, so these are really groups of developers, not unlike any Silicon Valley startup. So, you know, you go out to San Francisco or San Jose or Silicon Valley or, you know, New York, you can go anywhere in the world really, but associated with Silicon Valley, you can find teams of developers, and maybe some of them have experience at one of the, you know, big successful startups, whether it's, you know, PayPal or Uber or some of these apps, and they're working on new apps. You know, you name it, there's an app for it, of course. Well, they got to fund themselves. You know, they've got salaries and overhead and rents and equipment costs, et cetera. They're no different than any other startup. And the traditional way you do it is, you know, you go meet with venture capitalists, or you ask your mother or your family and friends, or knock on doors, do a private placement. I mean, there are traditional ways of funding any startup. And of course, more recently, we've seen what they call crowdsourcing or crowdfunding, where you just kind of throw it out there on a certain internet site and get people to give you money, basically. And original crowdfunding, they'd give you, you know, a T-shirt or a cooler or a ticket to a movie if they could produce a film, whatever it might be. Well, anyway, these ICOs are really nothing more than crowdfunding or crowdsourcing. But what you get, so okay, I send you hard dollars, so I send you $100 or $1,000 or whatever if I choose to subscribe to one of these, and what I get in return is one of these coins. They also call them tokens, and they'll have a name. You know, they've got different names. There's you know, DAO and Mastercoin, and they, as I say, they have many different names. So I get one of these coins, or maybe I get a bunch of them because I put a lot more money in. What do I get for my coin? Well, and here's where it gets really interesting, because in a normal startup, I'll sign a subscription agreement, send my money into the promoter, and I'll get shares. I'll get units, you know, limited partnership interests or LLC members' interests or stock or shares or something that goes on a ledger. Actually, or a capital table, a cap table. And from then on, I'm an equity holder. If the company fails, my equity goes to zero, you know, tough nuggies. But if it succeeds, maybe I just bought into the next Google at $1 a share, and someday it's $1,000 a share. So that's why people do it. They hope for those big kind of gains. Well, with the coin or the token that I get, it's not really a share. I don't get any voting rights. I don't get any dividends. And that's where I'm jumping ahead a little bit to the regulatory regime you talked about, Alex, but that's where the securities laws get tricky, because I mean, I can define the token any way I want. If I'm the creator and the programmer and the developer of this, I can define the token. And it's certainly possible that a token could sort of walk and talk like a share of stock. You know, the minute you tie the value of the token to the success of the enterprise, it's probably a security. The definition of a security for purposes of application of the securities laws, you know, the 33 Act and the 34 Act, and the ones we're familiar with in the U.S., but Europe and U.K. and others, Japan have similar securities laws. The definition of a security, I happen to be a lawyer. I mean, it's a little bit technical, but it's usually tied to some stake in the success or failure of the enterprise, but defined as the earnings of the enterprise. But what if my token says, well, no, Jim, you don't get any stock, you get no votes, you have no equity in this thing, but what you do is you get to use the app for free, or you get to sell it to somebody else, or you're going to get some certain, if the app is successful, you're going to get some certain privileges, or you can intersect something you're doing with what we're doing. So these things are you know, compatible in certain ways. And I realize I'm being a little bit vague right now, but the area is vague because there are a lot of ways to do this. So I might create a token that looks just like a security, in which case I probably, you know, unless I follow the private placement rules, 506B and 506C and some other laws. I could be breaking the securities law if I'm not careful. On the other hand, if the token is not much more than a token and the person buying it is hoping for the best and hoping that the token becomes more valuable because you got a front row seat on the next new app, I can sell it to somebody else. It might not be a security. It's some kind of property, right? It's some kind of speculation, but it might not be a security. But this is very new, very gray. I can just imagine traditional securities lawyers kind of pulling their hair out over this, trying to figure out what it is. I was involved in the very early days of the swaps market. Of course, swaps and derivatives are commonplace today. But going back in the late 70s, early 80s, when these things were literally being invented, I was International Tax Counsel at Citi and Citibank, and we didn't. We knew how to write them. We didn't know how to treat them in terms of tax treaties. Well, if you paid a swap payment, was that interest? Was it a dividend? Was it an insurance premium? I mean, you could argue that it was any one of those things. Today, there's a lot more clarity around that, but we were operating in a gray area. Same thing today with these ICOs. So, and then what are they? What are these apps used for? The ones that you're funding when you buy a token in an ICO. Well, one of the big applications today are what are called safe contracts, because transfers through a distributed ledger are both irrevocable, encrypted, irrevocable, and if not unhackable, at least sufficiently widely distributed that they're pretty safe. It's considered to have the potential to solve a trust problem in any transaction. So, go back to cavemen, cave women, and I don't know what the anthropological evidence is, but imagine, you just killed, a mastodon. You've got some fresh meat, and I just picked, a bunch of berries, and we want to barter. I want to give you some berries, and you're going to give me some of the mastodon meat. Well, what if I give you the berries first and you run away, or you give me the meat first and I run away, and might start a war or whatever. But there's that who goes first problem, and it even applies in modern times. Or maybe in the 19th century, I'm going to buy something from you, and I hand over my money, and you don't deliver the goods. You keep my money and don't deliver the goods, or vice versa. And this happens in a much larger scale when you're doing multi-billion-dollar corporate takeovers. Well, how do you handle all that? Well, the answer is through centuries and through law and contracts and precedent and court cases and enforcement and other things. We've developed tried and true ways of dealing with all these problems. If the buyer and the seller are remote and they're not face to face and you don't have a simultaneous exchange, you can use an escrow agent. You can use insurance. You can use a third party bank. You can use a lot of different trusted counterparties to solve that problem. So, in fact, I worked on one of the biggest problems like this in history when we were obtaining the release of the Iranian hostages. This is in 1979, 1980. And the issue there was Iranian militants broke into the U.S. embassy and took a bunch of Americans hostage. This was around the time of the Ayatollah Khomeini and the Iranian Revolution, after the fall of the Shah. But because it was sort of spontaneous, they hadn't really thought through where their money was. Well, it turns out a lot of the money was in U.S. banks, and all that money was frozen immediately. And after a year or so of negotiations, the U.S. obviously wanted the hostages back, and Iran had gotten enough propaganda value out of it, and they wanted their money back. And the U.S. was not going to pay ransom, but we took the attitude that, well, this isn't really ransom. It's your own money that we've frozen. We'll just be giving it back to you if you give us back our citizens. So that was the deal. But the problem was neither the Iranians nor the United States, and there were other Western banks involved, but I'll just say the United States, neither side trusted the other enough to go first. The U.S. said, well, look, if we send you the money, you guys are going to take the money, keep the hostages, and poke a stick in our eye. And the Iranians thought the same thing. If we release the hostages, you Americans will never give us the money. How can we trust you? So the way we solve that is we've said, well, the obvious way to solve it is to get an escrow agent, where you give the money to the escrow agent. He sits on it, observes the release of the hostages, and when the hostages are released, the money is forwarded to, in this case, Iran, but they're no longer trusting the United States, they're trusting the escrow agent. Then the problem was, well, who in the world was trusted by both sides? Who could the U.S. trust enough to send the money to in the first place? And who could the Iranians trust enough to know that they would actually get the money if they released the hostages? Turns out the answer was Algeria, because they were sufficient. There was the Central Bank of Algeria. They were sufficiently Western and sufficiently Islamic that both sides were happy. It's a long story, interesting one, but my point is that's how difficult it can be to solve this who goes first problem in any exchange. Well, with Ethereum and with some of the apps that are being developed under some of these initial coin offerings, that problem is solved through the protocol, which is that if I pay you, there's going to be some verification that you ship the goods, and when that happens, you automatically get paid. You're no longer relying on me to send you the money, and you know the money's waiting for you once you ship the goods. So these are called safe contracts, and a lot of people are working on apps for those. I question whether they're not solving a problem that doesn't exist, in the sense that, I mean, Amazon does quite a bit of business, and when I use my credit card to buy something on Amazon, I don't really worry that I'm not going to get my merchandise, and if I don't, I know I can get the credit card charge reversed, and it would be rare that if that were not true. So I don't consider there to be much of a problem. But if there's improvement on that, maybe Amazon would buy the technology. Who knows? But the point is, that's an example. So I realize I'm going on at length here, Alex, but I'm trying to make the point that there's the blockchain technology. There are cryptocurrencies. There are ICOs that are issuing coins or tokens that could be currencies, but they're really kind of property rights of some kind, hard to define, in a new app. And the apps themselves are performing these kinds of ledger or safe contract roles. So it's I don't want to mush it all together. I think there's too much of that. When people are kind of glib in the conversation, I do think it's important to make all of these distinctions so that we're not just throwing the word crypto around without a lot of content, but we know exactly what we're talking about.
Right. And I think the idea with the whole trustless thing is that it removes intermediaries, and in particular it removes banks as intermediaries and sort of the focal point of control of the transactions. And that's one of the things that I was trying to get at here is that if the currency that you're transacting any of these cryptocurrencies in other words, your cross rate or your cross currency, so all Forex is there's a cross rate, either it's USD RMB, or it's USD CHF, which is Swiss francs, or it's USD gold, for example. These are all examples of Forex cross rates, right? And what that means is you're converting these cryptocurrencies in and out of other types of currencies. And this is where your risk is at. This is where the potential for regulators to control that happens.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.